We're moving on to talk about profitability analysis. I'm going to try and get through all of this in one video, but there are quite a few ratios that we're going to cover in this video. But we're going to be looking at the relationship between the income statement and the balance sheet to evaluate profitability. Looking at profitability ratios, we've got asset turnover, return on total assets, return on stockholders' equity, return on common stockholders' equity, earnings per share on common stock, and then price to earnings ratio, dividends per share, and the dividend yield. Asset turnover is one of those where we're going to need to calculate an average again. So we're looking at sales over average total assets. We are not going to include long-term investments with the average total assets, so you need to remove those before you calculate your average. And again, you'll need 2 years worth of data to be able to calculate the total assets in order to get the beginning and ending figures. And here they have kindly given you those, and they have an asset turnover ratio of 1.2 and 1.4. And they've subtracted out their long-term investments, they tell us. The return on total assets, we've got net income, but you're going to add back in interest expense. So the net income is your bottom line income figure, and then you're going to add that interest expense back in, and then you're going to divide that by your average total assets. I should also add that what also differentiates this ratio from the prior one we just looked at is that the average total assets does not subtract out the long-term investments before that calculation. So we're back here to the Lincoln Company, and we've got a 7.3% return improved to an 8.2 return on assets. So we are doing better in year 2 on getting a return on our total assets. Now, we could have a company that derives a significant portion of its income from non-operating sources. Maybe it also owns a lot of real estate that it doesn't happen to be using, so it's renting some of that unused space out, but that isn't really part of its main operations. So we don't necessarily want to look at that as we did in the prior ratio, which looked at our total net income. In this case, we want to just look at how well we're doing in terms of getting a return on our assets related to just our operating income, not our total income. So that will be operating income over average operating assets. And then we get to return on stockholders' equity. That is net income over average stockholders' equity. So remember, anytime you see average, that's a really easy way. When I was taking the CPA exam, I would often get tripped up because I would get so focused on, I know the ratio, I know what this calculation is, and I would forget that it was an average. And so if you just take the ending stockholders' equity figure, you will not get that correct. And so as your slide points out, looking at the return on stockholders' equity, this can be made to look different than the return on total assets because of leverage. In other words, how much are we actually financing our operations with debt? So we can look at this kind of a nice little graphical representation here of these 2 years. The green being the return on stockholders' equity, the yellow, I guess, being the return on total assets. And the difference of those is the effect of leverage, or in other words, debt. Then we get to return on common stockholders' equity. This is another place that I would get tripped up on the CPA exam, so don't let this be you. I would get all excited and start calculating return on equity and forget that if there were preferred stock that I needed to subtract out preferred dividends from the net income. And that was time and again a place that I would get tripped up when running through practice problems, is I would just grab that average common stockholders equity and think, okay, net income. But so pay attention when this ratio rolls around as to whether or not you have preferred stock, and then if dividends were paid on that preferred stock. And if that's the case, you need to subtract the preferred dividends out of the net income in the numerator before you do the calculation. And so in this case, we've got an improvement of from 10.9 to 12.5% over the course of a year as a return. And so as with the difference between the return on equity versus total assets, the return on common stockholders' equity from total assets also differs because of the use of debt to fund operations. The next ratio we're going to talk about is earnings per share. And this is a reasonably easy calculation, and you won't appreciate how easy it is until you have to calculate something called diluted earnings per share. So, but don't worry about that for right now. Just be appreciative that all you need to worry about is regular earnings per share, which is net income minus the dividends paid on the preferred stock divided by the shares of common stock outstanding. This is particularly important because if we have treasury stock, you don't want to include treasury stock in your calculation because that's not common stock outstanding. So just beware in case you get a question that might try and trip you up in that way. So our earnings per share in the year 2005 were $1.35 per share, and then I should say per common share, and then $1.64. Things improved by the following year. So as I mentioned a moment ago, corporations can have really complex structures, and in order to accurately get an earnings per share calculation, those get skewed by things like preferred stock, stock options, and warrants. So in order to factor out those, you need to calculate something, what is known as diluted earnings per share. I'm not going to make you do that. You are welcome. I promise you. But just beware that if you've got these more complex kinds of structures, that calculating basic earnings per share is not going to be adequate, and you will need to calculate diluted EPS. Price to earnings ratio. This is a pretty basic one. It's the market price per share of your common stock divided by the earnings per share on common stock. So you might get a question where you have to first determine what the earnings per share is. So your basic EPS you would have to calculate in order to get your denominator, and then the market price is just whatever the stock is currently selling at. So they're nice enough to give you the basic EPS in this example, so all you have to do is plug it into the calculation. Dividends per share. So this is the dividends paid on common stock. Make sure that if there are dividends paid, that you're only looking at the dividends paid on common stock, not the preferred stock as well. I should say if there's preferred stock. In fact, I should just repeat all of this. So if there are dividends paid and you have preferred stock, make sure that you subtract out the dividends paid on the preferred stock before you make this calculation, because all we're looking at are common stock dividends and then the shares of common stock outstanding as your denominator. So often there may be a comparison made between dividends per share and earnings per share. And the earnings per share is, again, what we have earned per share of common stock outstanding. The dividends are based on what we've actually paid out to our common shareholders. The difference being what we didn't pay out is what stays with the company. So if we look at these two, we had basic earnings per share of $1.35 and $1.64 for each of these years respectively. We paid out dividends per share of 60 cents and 80 cents each, meaning that the rest of this, what is represented above the dividends, is what the company kept for itself in earnings to use in continuing to invest in maybe expansion or further operations or whatever the case. But companies will, or potential investors will look at how much the earnings per share were and then look at what they got and may want to have some expectation. Well, what are you going to do with the extra money that you earned on my investment and you're keeping? Are you going to invest it in something good? Then we get to the dividend yield. And so this is the rate of return to common stockholders from the cash dividend. And so we've got the dividends per share of the common stock over the market price of the common stock. So in other words, what is the percentage that they're getting back on dividends versus the stock price? And so in year 5, it was 2.2, and it was up to 2 in year 6. I should say down to 2 in year 6. All right, so we've got the checkup corner for the profitability analysis. You've got some work to do, and I'm just going to be quiet. Okay, so I'm actually going to stop this video here, and we are going to go on to the next video to talk about annual reports.